Welcome back to Journey to XRP. Today is a perfect example of why most people lose money in this market. Not because the asset fails, but because emotions override context. Over the last few days, fear narratives have been everywhere. Rising interest rates in Japan, pressure across risk assets, and the usual crowd saying XRP is about to fall off a cliff. And yet, here we are, holding levels that many people confidently said would not survive. That disconnect is what we need to talk about. This video is not about celebrating a green candle or pretending price action guarantees anything. It's about understanding why markets often do the opposite of what the crowd expects. Especially when sentiment gets stretched and confidence collapses, history shows that the most important moments rarely feel comfortable when they're happening. You're probably hearing a lot of technical arguments right now. Moving averages, oversold indicators, historical rallies, percentage comparisons to past cycles. Some of that data is real, some of it is selectively framed, and most of it gets abused to sell certainty where none exists. So instead of asking whether XRP is about to explode, the smarter question is this: what actually changes when price holds up despite negative macro pressure? Because that's where information lives, not in excitement, but in resilience. We've seen this pattern before. Extended periods where patience is tested, where conviction erodes, and where people start convincing themselves that walking away is the smart decision. Historically, that mindset tends to show up close to inflection points, not because rallies are guaranteed, but because weak hands exit when pressure peaks. The goal today is not to tell you what XRP will do next week or next month. The goal is to help you understand why narratives swing so violently, why people anchor to past moves without context, and why infrastructure and fundamentals matter more than short-term sentiment ever will. If you're here looking for price promises or Christmas miracles, this isn't that video. But if you want to understand why XRP continues to matter even when confidence is shaken, and why markets often move when conviction is lowest, then you need to stay with me. To really understand what's going on right now, we have to separate noise from signal, because most people are reacting to headlines without understanding how markets actually process stress. Rising interest rates in Japan sound dramatic, and on the surface, they should pressure risk assets. That assumption isn't wrong, but it's incomplete. Markets don't move on single variables. They move on how expectations collide with positioning. When everyone is leaning the same way, outcomes change. Japan tightening policy matters because it affects global liquidity. For years, cheap yen funding supported risk-taking across equities, bonds, and crypto. When that dynamic shifts, capital becomes more selective. That doesn't mean everything collapses instantly. It means money stops chasing marginal bets and starts paying attention to resilience. Assets that can hold ground during tightening phases tell you something important about positioning underneath the surface. That's why price holding above key psychological levels matters more than any single indicator. Not because it guarantees upside, but because it signals that selling pressure is being absorbed. If the market truly believed that rising rates were an immediate death sentence for XRP, you wouldn't see stability. You'd see acceleration to the downside. That hasn't happened. Now let's address technical narratives because they get abused constantly. Moving averages and RSI are not magic signals. They don't cause price to move. They reflect what has already happened. When people point to historical rallies that followed prolonged weakness under certain averages, they're not wrong, but they often leave out context. Those rallies didn't happen because of an indicator. They happened because liquidity conditions changed, positioning was exhausted, and new demand entered the market. Oversold conditions don't mean price must go up. They mean selling pressure has dominated for long enough that marginal sellers are fewer. That's a setup, not a trigger. Without a catalyst, markets can stay oversold longer than people expect. That's why relying on indicators alone is how traders get chopped up. What's different now compared to many past periods is that this market is far more institutionally observed. ETFs, custody providers, compliance frameworks, and regulated on-ramps have changed who participates and how capital moves. This doesn't make the market safer or faster, it makes it more deliberate. Price doesn't respond instantly to fundamentals anymore. It responds when capital is allowed and incentivized to move. Another mistake people make is romanticizing past cycles. In 2017, the majority of participants had no framework for valuation, risk, or timing. Everything felt explosive because liquidity was abundant and regulation was absent. Today's environment is the opposite. Liquidity is controlled, regulation is front and center, and volatility is increasingly constrained by structure. Expecting the same emotional behavior ignores how the system has matured. That maturity frustrates retail participants because it removes the illusion of easy money. Long periods of sideways action feel pointless if you're only focused on price. But from a system perspective, sideways action during macro stress is not weakness, it's digestion. Markets don't trend endlessly, they breathe. It's also important to understand sentiment cycles. Fear doesn't peak when price is lowest, it peaks when patience is lowest. That's when people start convincing themselves that fundamentals don't matter anymore, even though those fundamentals haven't disappeared. Tokenization discussions haven't stopped. Settlement modernization hasn't stopped. Regulatory engagement hasn't stopped. What's changed is the speed at which people expect results. This is where many get shaken out, not because they were wrong about the long-term direction, but because they underestimated how long the middle part of the cycle lasts. Consolidation phases exist to punish impatience. They don't reward conviction loudly, they reward it quietly. So when you see XRP holding ground while fear narratives dominate, don't rush to conclusions. It doesn't mean a rally is guaranteed, it means the market is still deciding, and decision-making phases are where weak assumptions get exposed. This is the point where most retail narratives completely fall apart because institutions are not looking at this market the way individuals are. Retail looks at charts and asks, is this about to go up? Institutions look at structure and ask, is this system proving durability under stress? Those are two very different questions, and they lead to very different behavior. When markets are under macro pressure, smart money is not trying to front-run a breakout. It's trying to avoid being wrong. Capital preservation comes before capital growth. That's why you don't see institutions chasing rallies during tightening phases. They wait for confirmation that liquidity conditions, regulation, and infrastructure are aligned. Until then, patience is not a choice, it's policy. This is also where people misunderstand accumulation. Accumulation is not loud. It does not look like parabolic candles. It looks like boring price action, low volatility relative to fear, and steady absorption of sell pressure. If you expect accumulation to feel exciting, you will miss it every time. AI models tend to recognize this because they are blind to emotion. They only see distribution patterns, volume behavior, and duration. Another key difference is time horizon. Retail participants often operate on weeks or months. Institutions think in years. That means they are comfortable with extended periods where price does nothing, as long as the underlying thesis remains intact. In fact, those periods are preferred because they allow positioning without competition. When price is euphoric, risk is highest. When price is ignored, risk is often lowest, assuming fundamentals haven't deteriorated. Liquidity again sits at the center of this. Institutions understand that liquidity does not return because people want it to. It returns when policy allows it and when incentives align. Right now, liquidity is constrained, but it is not destroyed. That distinction matters. Constrained liquidity creates compression. Compression creates asymmetry, but asymmetry only resolves when something changes in the system. Retail tends to misinterpret this compression as failure. They see time passing and assume opportunity is disappearing. Institutions see time passing and assume weaker participants are being filtered out. This is not moral judgment, it's market mechanics. Markets are designed to move capital from impatient hands to patient ones. Regulation plays a huge role here. Institutions cannot act on belief, they act on permission. That's why regulatory progress matters even when price doesn't react. Legal clarity, compliance frameworks, and reporting standards are prerequisites for scale. Without them, large pools of capital remain sidelined, no matter how attractive the chart looks. This is also why institutional adoption rarely shows up as immediate price appreciation. The first phase is infrastructure readiness. The second phase is pilot usage. The third phase is integration. Price responds late in that process, not early. Retail often expects price to lead adoption. In reality, adoption leads price quietly. AI-driven analysis reflects this because it prioritizes sequence over excitement. It doesn't assume that because something is oversold, it must reverse. It asks whether the conditions for sustained demand exist. If they don't, patience is the only rational response. Another uncomfortable truth is that many people confuse conviction with stubbornness. Conviction is the ability to hold a thesis while constantly reevaluating it. Stubbornness is refusing to question assumptions. Institutions survive because they are ruthless about invalidation. If data changes, they adjust. Retail often clings to narratives even when conditions shift. Right now, the data does not suggest a broken system. It suggests a system under pressure, consolidating, and waiting for alignment. That's not exciting, but it's not catastrophic either. The danger lies in forcing conclusions before the market has finished its work. So when you hear confident voices saying, this must happen, or this always happens, understand that those statements are emotional shortcuts. Markets don't owe anyone repetition. They only reward alignment. Now let's talk about XRP specifically, because this is where a lot of people completely misread what they're holding. XRP should not be evaluated like a short-term speculative trade, and it also shouldn't be treated like a meme asset that lives and dies on sentiment. Its relevance is tied to function, not excitement, and that makes its behavior during stressed markets very different. XRP exists in a category that most retail investors don't fully appreciate: financial infrastructure. The XRP ledger was designed for speed, finality, and low-cost settlement. That matters far more in environments where institutions are cautious than in periods of reckless speculation. When liquidity is abundant, everything looks good. When liquidity tightens, assets with no clear role get exposed quickly. This is why comparisons need to be done carefully. Bitcoin increasingly behaves like a macro asset and collateral layer. Ethereum operates as programmable settlement and smart contract infrastructure. XRP is positioned as a liquidity bridge, facilitating movement of value between systems, currencies, and eventually tokenized assets. These are different jobs. They don't cancel each other out, and they don't compete on the same timeline. What makes XRP particularly sensitive to misunderstanding is regulation. XRP's adoption path is directly linked to legal clarity and institutional permission. That slows down visible price action, but it increases long-term viability. Institutions don't experiment with settlement rails casually. They test, integrate, and scale cautiously. That process is invisible to most retail participants, which is why people assume nothing is happening. But step back and look at what hasn't stopped. Discussions around tokenization of real-world assets are accelerating, not slowing down. Cross-border settlement inefficiencies are still being actively addressed. Stablecoins, private-public partnerships, and digital settlement frameworks are moving forward across multiple jurisdictions. None of this requires hype. It requires infrastructure. This is where XRP's design becomes relevant. A neutral bridge asset with fast settlement and low friction fits naturally into a tokenized financial environment. That doesn't mean XRP automatically wins. It means it remains relevant. And relevance during consolidation phases is far more important than popularity. Retail investors often expect XRP to behave explosively because of past cycles. That expectation ignores how much the market has matured. Price doesn't move simply because something is oversold or historically did well under similar conditions. Price moves when capital has both the ability and the incentive to deploy at scale. XRP's strength in this environment is not that it's immune to drawdowns. It isn't. Its strength is that its thesis doesn't depend on constant speculation to remain valid. That's a critical distinction. Many assets require continuous narrative support to justify their existence. XRP does not. The risk, of course, is execution. Infrastructure assets live or die on adoption, not belief. If integration stalls or regulatory progress reverses, the thesis weakens. That's a risk that should be acknowledged, not ignored. Long-term confidence without accountability is not analysis, and it's faith. So when people panic because XRP isn't moving fast enough, they're usually projecting the wrong expectations onto the wrong type of asset. XRP is not designed to reward impatience. It's designed to operate when systems need efficiency, not excitement. At this stage, the most important thing you can do is stop demanding certainty from a system that doesn't offer it. Markets don't move on belief, loyalty, or how long you've been holding an asset. They move when conditions align. And right now, the conditions are still in the process of resolving, not collapsing, not exploding, resolving. This is where mindset matters more than timing. Most people don't lose money because they picked the wrong asset. They lose money because they couldn't tolerate the middle, the long, quiet, frustrating stretch where nothing seems to validate their decision. That's the phase where doubt creeps in, narratives get louder, and people start rewriting history to justify exiting at the worst possible time. But here's the hard truth. If XRP's long-term thesis is correct, it will not reward impatience. It never has. The moments that mattered historically didn't come after comfort. They came after exhaustion. That doesn't mean a rally is guaranteed. It means emotional capitulation usually happens before clarity, not after it. You don't need to be euphoric right now. You don't need to be bullish every day. You don't even need to be fully invested. What you need is alignment between your expectations and reality. If you're treating a long-term infrastructure asset like a short-term trade, you're setting yourself up for frustration. This phase is about discipline, about understanding why nothing feels urgent even though everything feels important, about resisting the urge to constantly do something just to feel in control. Markets punish that behavior far more consistently than they punish patience. If liquidity improves, if regulatory clarity continues, and if institutional infrastructure keeps progressing, XRP will reflect that in time. If those things stall, then reassessment becomes necessary. Both paths require honesty, not hype. So don't let noise rush you into conclusions. Don't outsource conviction to influencers, charts, or AI models. Use tools for context, not direction. Let structure guide behavior, not emotion. And remember this above all else. This content is for educational purposes only and is not financial advice. Always do your own research and consult a licensed financial professional before making any investment decisions. That's where we'll leave it.